So today I want to talk about the multiplier. This is a concept that probably more than any other sort of defines the popular idea of what Keynes and Keynesian economics is all about. Although, as we know, Keynes's actual social and economic thought was much broader and more complex. But the multiplier is one of the sort of key practical takeaways for policy and a tool we still talk about quite a lot. The debates around the Biden stimulus and relief package, for instance, include extensive discussions of what is the appropriate multiplier to use when thinking about the impact of the proposed spending on the economy and whether it's an appropriate size given what we think we know about the trajectory of output over the next year or several years and what we think is possible or desirable in terms of the economy's potential. So the multiplier is both part of the sort of Keynesian legacy, but also a sort of basic workaday concept in macroeconomic policy debates. So it's worth taking some time to go through it step by step and then to review some of the sort of empirical evidence about multipliers in the real world. So the starting point here is this simple, and in some ways, this is sort of the simple and yet in some ways kind of revolutionary way of thinking about the relationship between spending and production that Keynes developed. Expenditure determines income. This is just our starting point. That the total amount income is generated when somebody buys something in the marketplace. Total income in the economy depends on the total spending in the economy. Well, that's again a different way of thinking about it than if we imagine as in other economic contexts, people sometimes tend to, Robinson Crusoe on his island, where his total income depends on, the natural resources available on the island and his skill and time spent on capturing those for his own use, catching fish, harvesting coconuts, sewing reed mats, whatever you do on an island. It was actually a news story. Maybe some of you saw it just recently about a group of people stranded, I believe, on an island in the Bahamas, an isolated desert island in the Bahamas. And it seems they did, in fact, survive in large part for over a month. And they did survive in large part on coconut. So I guess that is one of the things that you do on a desert island. Anyway, in that vision, your income depends on the productive resources available to you and the labor that you put into appropriating them. In our Keynesian vision, income in the aggregate depends on spending. The total amount of income that people, business owners, capital owners, and workers receive depends on the total amount of purchases in the economy. On the other hand, people's decisions about spending are influenced by their income. People's consumption choices are strongly affected by their income, both because people are often liquidity constrained and need their current income in order to pay for their current expenditure, but also because your beliefs about what is over the long run a reasonable, acceptable, sustainable level of consumption are based on your ideas about your future income, and your idea of your future income is largely derived from your current income. And other agents, actors in the economy to different degrees are also going to be basing their expenditure decisions on their current income. So we've got expenditure determining income influencing, affecting expenditure, and that creates a positive feedback loop, a sort of cycle between income and expenditure. So that an increase in spending, increase in business investment, increase in government spending, as we often imagine, increase in exports, which are spending by the rest of the world on our goods, has an immediate effect on raising production. Again, this is our sort of core Keynesian starting point, that the amount that businesses produce is typically less than they physically are capable of producing. So when more spending comes their way, their production goes up. So in the first instance, the decision by a government body to hire more teachers or hire people to deliver vaccines or whatever creates activity that wouldn't otherwise have taken place in the economy. A decision of somebody outside of this country to buy a product from this country results in a sale and in production that wouldn't otherwise have happened in this country. But then that creates incomes in this country, and those incomes in turn produce further expenditure, further consumption, typically as we imagine it on the part of the workers and perhaps also the business owners or profit recipients. And that further spending then, of course, creates more production and more incomes and so on. So there's this sort of, there's the direct effect on GDP, but then there's, or output, but then there's an indirect effect that continue, in principle, over an infinite number of diminishing cycles. And that's sort of the notion of the multiplier. So, So a few basic concepts, terminology we should remember here. When we talk about expenditure in this context, we mean spending on currently produced goods and services. We're not talking about, and I'm going to say goods for goods and services from now on. We're not counting spending that falls on the purchase of existing assets or spending that takes the form of a transfer to somebody else, a gift, an interest payment, a transfer made by the government in the form of some type of social benefit on employment insurance or Social Security payments or by a business. These types of spending are not an expenditure. What we're talking about here are purchases of currently produced goods. And income, similarly, we're talking about income derived from production, basically wages and profits, and then some smaller categories. Although profits, as a reminder, do include retained earnings by the firm as well as dividends that are paid out to shareholders. And all expenditure then by this definition is income, because all of the spending, the value of a good is equal to the amount that was spent for it, and all of that spending is received by somebody because we've defined profits as simply the difference between the sale price and all other costs. So whatever residual is left is profits, again, whether it was paid out to shareholders or not. And then on the other hand, when we say saving, we simply mean income that was not spent on consumption goods. So saving is just defined in a negative sense. The difference between income and consumption is savings, both at the level of the individual or sector or the economy as a whole. So we think of savings as typically being done by households, but in reality, a lot of the savings in the economy is in the business sector where, as I said, retained earnings, a lot of profits. Historically, it's higher now. Historically, businesses paid out, corporations. Small businesses are tricky because in small businesses, there's no actual way of distinguishing the profit of the business from the income that the employer earns that the owner receives as an employee. In other words, if you own a small business, you take home a certain amount of money at the end of the year. Conceptually, some of that is wages for the work you did running your business, and some of it is profits from your ownership of the business. But those two things are completely, they're not distinguished in any way. You just took home a sum of money at the end of the year. So there's a lot of challenges around that category of income called mixed income or proprietor's income. Fortunately for our purposes, in the US, most other modern economies, the bulk of private sector activities in the corporate sector, where there's a clean distinction between wages paid to employees, including managers, and profits. Although, if we want to complicate things, we can say, well, maybe some of those wages at the very high end are really a form of profits. But anyway, bottom line here, savings we think of, and certainly Keynes discusses savings as something that happens in the household sector, but in fact, a lot of savings in the economy happens in the business sector in the sense that there are profits that are not distributed to households, and therefore, since there's no consumption that happens in the business sector, by definition, any income that remains within the business sector is a form of saving. All right, so yes, so we've got our saving, we've got our income, which is income from production, expenditure on currently produced goods. Okay, so now if you reduce your consumption, again, all expenditure is income for somebody. If you reduce your consumption spending, you're reducing somebody else's income. If their consumption doesn't change, so let's imagine this. You were spending $100 on consumption over some unspecified period of time. This period of time, you spend $90 on consumption. You've reduced your spending by $10. You've increased your saving, assuming your income hasn't changed. You've increased your savings by $10. Before, maybe you received $100 income, spent $100 on consumption, had no saving. Now you receive $100 in income, spent $90 in consumption. You have $10 of saving, but your consumption spending is income for somebody else. If you reduce your consumption spending and whoever else was receiving that income doesn't change their behavior, their savings by definition goes down by $10. If you did not buy a product from a business that you were planning on buying, this is unexpected. The business doesn't have time to make any adjustments to their plans. They simply have $10 less of profits, which means $10 less of savings. If they reduce their employment, then somebody else is losing wage income, labor income. And again, if they don't change their consumption, their savings declines by the same $10. If they do reduce their consumption, their savings doesn't decline, but then we just push the problem on to the next person in the economy, the next unit, and they're the ones who are now have their income decline and going to have their savings decline. The point of all this is that, and this is a sort of central feature of the Keynesian vision, your individual decision to consume or save has no effect on savings in the aggregate. Households' decisions to consume more or save more do not affect total savings at all, because when you reduce your consumption, you're increasing your saving, but you're reducing someone else's income. If they don't change their behavior, then their savings falls by exactly as much as your savings went up, because again, remember, savings is income minus consumption. If they do reduce their consumption spending, then you just push the problem onto the next unit until finally somebody does not reduce their consumption and dissaves, and the total dissaving is equal to the amount that you increased your savings. So there's no way for a individual choice between consumption and savings to influence aggregate savings in the economy. All it does is affect total income in the economy. If you or some representative subset of the household sector, the household sector as a whole, decides we are going to consume less this period of time, the result of that is that total society-wide savings is going to be the same, but total income is going to be lower. Well, this is a little weird when you first hear it, but it is a core feature of the Keynesian system, and it follows from this basic algebra of the national income identity. If Y, let's say if Y equals C plus I plus G plus X minus M, and the key thing is we're interpreting this causally. The stuff on the right is what determines Y. It's what makes Y what it is. Now, if we say S equals Y minus C, okay, you try to increase your savings by decreasing your consumption here. But the effect of that is simply to decrease Y. And the effect of that is that C and Y go down by the same amount and S is unchanged. That's sort of the part of the conceptual underpinning of the multiplier. And the key assumption that makes that true is this, that we're interpreting this equal sign here as not just an identity, but as a behavioral relationship. It's not simply that since we've decided to slice output into these different spending categories, the parts have to add up to the whole. It's that we actually think the spending in each of these categories is being determined independently, and then whatever that total turns out to be, that's what determines output. So again, when you reduce your consumption spending, the effect of that is to reduce output by the same amount, and therefore, since these two things fall by the same amount, this S is left unchanged. Okay, so again, this is the core background to sort of, there's a lot of ways to come at the multiplier concept, but this is also a sort of core concept in our vision of the economy. Now, of course, the same is going to be true in reverse if you increase consumption. if I increase my consumption, I'm reducing my savings, but I'm creating income for somebody else. And so the net effect is that's, the economy savings as a whole is unchanged. If I increase my consumption just out of the blue, my own personal savings, as we measure it, goes down. But somebody else's savings elsewhere goes up by the same amount. So aggregate savings is unchanged. Okay. So let's come at this another way. Different people's spending plans have to be consistent. The question then becomes, given that people's spending is in some part a function of their income, at a given income, let's say Y1, at a given income, is the planned or intended total spending of all the units in the economy equal to that same income? Because again, remember, income is determined by spending. Total spending has to equal total income. So if there's if at a given level of income, people would actually choose a different level of spending, then in the event, somebody must have spent the wrong amount. Either their spending was greater or less than they intended it to be, or their income was different from they expected it to be. And one particularly important category of this is what we call inventory investment, which is unsold goods and goods in process that are in possession of of corporations, of the producer at the end of the period, or specifically the change in that. It's the change. Inventory investment is the change in the stock of unsold goods in the hands of producers over the period. And this is important here because basically the notion is everything that is produced is purchased by somebody. If a business paid out wages to its employees during a period, that's income, and we think that there is some productive activity happening, but the result of that productive activity is simply, let's say, a bunch of cars sitting on a lot that have not been sold yet, then to make the accounting work, we say, since that there has to be some corresponding expenditure to go with that production and that income, we say that the corporation purchased the cars itself as inventory investment. Even though no money changed hands, that's what we call it. And there's a certain logic to that, since obviously at the end of the period, the company did lay out money for wages and for other inputs. And at the end of the period, they were in possession of the cars. So to say they purchased the cars as a form of investment because they're going to sell them in the future is logical. And the effect of that is to ensure that there is always some category of spending that corresponds to production and income that we observe. So in one case, if businesses expect a certain level of expenditure and households choose a different level of expenditure, the result of that is going to be that stock of unsold goods is going to go up or down. If businesses expect to sell more than they actually do, they're going to be left with unsold goods at the end of the period, and that's going to be positive inventory investment. If they expect to sell less, if business is better than they thought it would be, if they sell more than they expected, their inventories are going to go down, and that's going to appear as negative inventory investment. In either case, effectively somebody, in this case, the business, finds that they spent a different amount than they planned to. They planned on a certain level of investment, but then they ended up in addition with some positive or negative inventory investment. But they're going to obviously, in that case, change their behavior next period. If your inventories are growing, that says you're producing too much, you need to produce less. But to do that, you're going to not hire as many workers. That's going to reduce incomes in the economy and reduce the amount of spending until we get back in line. Or in the other case, if inventories are declining, businesses see they're not producing enough, they're going to try to increase production, which means hiring more workers, which means raising incomes. And that increase in incomes is going to eventually generate just the right balance between production and income in both cases. Or the other way you can imagine this is that households find themselves with an income different than they planned on. If they chose what they thought was an appropriate level of consumption, but then they find their income was different. For instance, they lost their job or whatever. So the effect of this, is the effect of this is that if there's some change in spending in the economy, it's going to generate incomes, And at that point, other agents in the economy are going to find they're spending the wrong amount. Again, suppose you decide to save more by buying less. You decide not to buy the piece of, whatever. You're gonna not go out to a restaurant that you planned on going to. The first immediate effect of that is to reduce the income of the restaurant. Their profits are less. And they may also, because restaurants can adjust staff very quickly, they may also lay off some of their workers. Now those workers find that they spent the wrong amount on consumption. They made consumption choices in the belief that they would be keeping their jobs. When they're laid off, they find their level of consumption spending is not what it should have been. It is now at the new level of income, they are spending too much. So they have to adjust their consumption decisions down as well. And so that is going to reduce income to somebody else, and they're going to adjust it. And sort of the one of the key pieces here is that Keynes noticed that if you have this basic form of the consumption function, you can say this process is going to reach a definite ending point. I spend less at the restaurant. Restaurant workers are laid off. Oops, now they find their income is lower than they thought. They need to spend less. So initially they're dis-saving because they're spending as much as they were planning to and their income isn't there. So they're dis-saving as much as you saved by not going to the restaurant. But that wasn't what they planned or expected. So they need to reduce their consumption spending. That's reducing income for somebody else. And then that somebody else finds, oh, now my income is lower than I thought. I need to reduce my spending. The point is, this process does not go on forever. It doesn't continue until economic activity shuts down. It reaches an ending point. And so sort of one of the sort of insights that gives rise to the multiplier is that if you have a sort of simple but reasonable model of the consumption function, you can say what that ending point will be. How far does this initial change in spending sort of propagate through the economy before you reach a new point where people's decisions are consistent, people's plans are consistent, where people are spending the right amount from their point of view, given what their income turns out to be. So this gets us to this very simple math here. Oops, I have a little, well, you can guess that little snippet of code there is supposed to produce a left arrow. Anyway, I'll fix that before I distribute it. But anyway, let's at least make it a left arrow here. There we go. Okay, better. Now, we've got basically two, in our very simple case, we're going to, for now, ignore the government, ignore the foreign sector. So we've just got consumption and investment. So we've got our simple accounting identity. Output is equal to the sum of consumption plus investment. It's the sum of consumption and investment spending. It's an accounting identity, but as I say, we're also interpreting it causally. And then we've got a second behavioral equation that tells us what we think consumption is going to be. And that says this thing: consumption is a function of something autonomous, exogenous, that's C sub 0 there, and a function of income. And that little parameter, lowercase c, and again, I'm usually writing my parameters as lowercase letters, that's going to be between 0 and 1, but probably relatively close to 1. And the fact that it is less than 1, strictly less than 1, is what guarantees this process is going to come to a resting point. Because when you reduce your consumption spending, that's reducing somebody else's income. When their income goes down, they're going to reduce their consumption spending, but less than the fall in their income. Because that C is less than 1, the second fall in consumption is going to be less than the initial one. And the fall in consumption that gives rise to is going to be less than that one, and so on. And so these effects, although they're going to continue through the economy, your initial decision to eat less at the restaurant reduces income for the workers. The workers at the restaurant decide they have to, cut back. They're not going to, take the vacation they were planning on. So their spending on travel goes down, and then that leads to a reduction in incomes for whatever the people who would have been providing the transportation or tourism services, those people. So their income goes down, and that continues through the economy, but it dies out, it diminishes, because at each stage people reduce their consumption by less than the fall in income, because that parameter lower little c is less than 1. On the other hand, it's not close to 0. If it were close to 0, we could just ignore this effect. The multiplier wouldn't matter, but because it's close to 1, the multiplier can be substantial, but because it's less than 1, the multiplier will be finite. So then we often talk about, autonomous spending being, the stuff that is not a function of income. So we've got our autonomous consumption, autonomous investment spending, government spending, and then it can be useful to think of C as planned consumption or as Y as expected income. Because again, in a situation, you'll have a situation where the multiplier is operating, where people are not consuming the amount that they would have chosen to consume given what their income turned out to be. So you've got to have some kind of, or we could introduce our inventory investment in here, but that would be an extra variable that we don't need to tell the story. So we think of this as planned consumption or expected income. People choose to consume a certain amount based on what they think their income will be, and then in the event, either it is or it isn't. So this gives us then some algebra. All right. We started with this thing. Rather, we go all the way back, up to here. We started with this thing. Y equals consumption plus investment. Now we're going to break up consumption into these two components. We're going to substitute in that term for consumption here. So instead of writing C, we write C0 plus little c times Y. So now we've got this thing. This is our description of GDP. Now we're going to just combine those Y terms, move the Y term over to the left-hand side. So we get Y times 1 minus C, because we've subtracted CY from each side, equals C0 plus I. Now we divide through by this thing. Divide by 1 over 1 minus C. And that gives us this. And this right here is the multiplier. This is the simplest way of deriving the idea of the multiplier, 1 over 1 minus C. So you can think about it. Suppose, for instance, that we think people consume 3/4 of their income. Suppose we think people, if we think, as a first guess, I don't know, maybe C equals, maybe it does. People at the margin consume 3/4 of their income. Then we could write 1 over 1 minus 3/4 equals 4. In this case, the multiplier would be 4. Now, the notion that people at the margin save 25% of their income is pretty reasonable. If anything, that's a low rate of savings. We might think the marginal propensity to consume. And incidentally, I should have mentioned this before. This thing here we also call the marginal propensity to consume. So we might think the marginal propensity to consume is greater than 0.75, 0.8, 0.9. On the other hand, as we'll see, 4 would be a really high guess for the multiplier. It would be very hard to find somebody who thinks in a real economy, the multiplier for practical purposes is as high as 4. So obviously we've got to add some more to our story to make it give us more realistic results. But in the simplest case, you have 1 over 1 minus C, and that's the multiplier. The higher the proportion of people's income they consume, the higher the multiplier will be. And again, if we think about what the multiplier means, it makes sense. When you go and you cut back your spending at the restaurant, how much additional spending does that then remove in the rest of the economy? Well, it depends how much the restaurant workers would have spent out of that income. The more of their income they would have consumed, the more income is lost at the next step of the process. So on average, the higher the proportion of income that is consumed at the margin, the higher the impact is going to be of any change in spending. Now, to make this a little bit more complicated, but a little more realistic, we can think about some other things that might happen to income. Again, we think initially that any income that isn't consumed is saved, but there's other things that can be where income can go. It can go to taxes, in which case it's not received by the household, so it's not part of household savings. Or it can go to imports. Import spending is if it's consumption, or it's a reduction from savings, but it doesn't create income or demand elsewhere in this economy. So to the extent that we have taxes that are collected as a fraction of income, or we have imports being purchased out of income, that's going to tend to reduce the multiplier. It's going to, because that's a form of expenditure that does not contribute to demand. It doesn't create incomes elsewhere in the economy. For simplicity, we tend to think imports are, at least, we can think of them as basically a fixed fraction of income, at least at the margin, and we don't need to worry about anything else. We can just say the imports are a fraction of income. Taxes, it's useful to think about both the possibility of a lump sum tax that's just collected based on some formula, not literally a lump sum, not literally a head tax. It could be any formula except that it's not directly connected to current income. So we call it a lump sum tax. It just means taxes that are not directly connected to current income. And then the alternative is a tax that is directly connected to current income. So then we're going to have a marginal tax rate on income. And then when we talk about taxes, we're always talking about taxes net of transfers, because just as taxes are income that's not available to be spent in the household sector, transfers are additional income that is available to, even though it wasn't created in the household sector, it wasn't generated in the household sector, but it's available to be spent in the household sector. So in the context where we're talking about the multiplier, when we talk about, we're always talking about taxes net of transfers, or if we say taxes as shorthand, it means taxes minus transfers. So if we think of income net of taxes, the word for that is disposable income. That's the income that's actually available to the household sector to spend. Now, we really should also at this point subtract retained earnings, because again, we think of profits as being income. But profits that are not paid out to shareholders, profits that remain within the firm, are also not available for the household sector for consumption. So we really should think of disposable income as netting out taxes, less transfers, and also netting out retained earnings. But that in practice is very hard to do, because there's a lot of payments between businesses and households that are hard to account for and are not consistently accounted for. Dividends are straightforward. But unfortunately, we also have buybacks, which are a big part of how profits are distributed to households. Buybacks are very hard to fit into our accounting system, because they're not savings from the point of view of the corporate sector. They look just like, to the point of view of the business making the buyback, a buyback looks just like a dividend. But they don't directly appear as income in the household sector, because from the household's point of view, when they participate in a buyback, they're just selling their share just as if they were selling it to anybody else. And again, we normally do not count money that you get from selling an asset as income. Income is income from the production process. Sale of an asset is not income normally. But on the side of the corporation making the buyback, this actually does look like a payment related to the production process in the same way dividend is. So besides whatever larger problems corporate buybacks, share buybacks may pose for the, incidentally, people who don't know, corporations buy back their own shares as a way of distributing money to their shareholders. Again, you own a share of a company, you receive a dividend every quarter, or whatever it is, I think usually money you get by virtue of owning that share. But in many cases today, you also get a fair amount of your return on that share. It comes from the corporation steadily buying back those shares, so that even if nothing else changes, the shares continue increasing in value. But again, the sale of the share to the corporation, or the capital gain you get if the share increases in value as a result of the buyback, is not something that we count in our measure of income. So that makes the payments between the corporate sector and the household sector very, very hard to measure properly. Pensions are another area where things get very funny, because when the corporation makes a contribution to a pension fund, from their point of view, that's a payment they're making to their employees. That should be counted as labor income. But from the household side, they don't receive the income until they actually receive a payment from the pension fund, which, those things could be separated in time by decades. And, at the level of the whole sector, if the system were stable, the money going in and the money going out would balance, but the system isn't stable. In particular, defined benefit pensions have declined steeply over the last few decades, which means So anyway, the point of all that is if we were going to talk about disposable income, we'd also want to maybe have do something about pension funds, but it just gets messy. So what we actually do is we usually say disposable income is just income net of taxes. All right, so let's do that then. Let's make our equation a little more complicated, but a little more realistic. So now we've added we've added now we've added these other terms over here. We've added investment spending, which we won't worry about for now. We've added government spending, which we won't worry about for now. We've added imports and exports. Well, we do have to worry about imports. They come in here. And now we're making consumption a function of disposable income instead of total income, logically enough. As we said, income that's taxed is not available to be spent. And disposable income we're defining as income net of taxes, including both these lump sum taxes that aren't related to income and then a marginal tax rate, T. So then we've also got M here, by the way, this is imports, not money stock. And that we're making imports just a function of income. So we've got our marginal propensity to import. All right, so now we've added taxes and trade to this thing. And the important thing is we've added two additional leakages, two additional places income can go where it's not creating incomes or demand in our economy. We don't consider income in the government sector. Taxes are they're just in this context just a leakage, a loss of income, and imports obviously a loss of income for our economy. So we've got our disposable income, which is YD there, our lump sum tax and marginal tax rate, marginal propensity to import, that little m, and then big M again is total imports. And so now we can write a slightly more complicated equation, but one that works a little better for our purposes here. We're going to combine all our y terms again. Everything that is well, okay. First, we got consumption is a function of we got to subtract taxes to get our actual consumption, and then we've also got to subtract imports since imports are a subtraction from demand. So now we combine all our y terms over here, and this stuff is our autonomous spending. Autonomous meaning not connected to current income. That's autonomous spending not connected to current income. So now we'll call the savings rate little s. It's also marginal. And that's just 1 minus C. Income, disposable income is either consumed or saved. And that gives us a new expression for output. We just divide through by this thing. We're going to call all this stuff A. Then we'll divide through by this thing and we get this. And so now this thing here is the multiplier. Well, you can see this number, since M and T are going to be positive and ST is going to be quite small, this thing is going to be large. It's going to be smaller than our original multiplier. This thing is we're not going to end up with reasonable parameters. We're no longer going to end up with a really high value like 4 here if we try to calculate this based on values that we think fit a real economy. Now, in practice, we can if the savings rate is 10 or 20% and the marginal tax rate is 10 or 20%, then ST is going to be like 0.01. So we can safely ignore it's going to be very small. So in practice, you can ignore that term if you want to solve a problem in a classroom and you want to get exactly the right answer, you can use that little st. But in practice, when we're this thing in the real world, we don't have precise values for any of these terms. It's estimates, it's guesses, and so we can ignore that. It's not going to change our results very much. Okay, so again, disposable income, income not collected as taxes, add transfers, payments to households like Social Security, unemployment insurance, Medicaid. This stuff is not counted in G. It's not part of autonomous government spending. It's not directly a contribution to GDP, but of course it is going to indirectly contribute to GDP because it's added to household disposable income and therefore increases consumption. And then, hypothetically, we'd like to put the stuff from businesses in here too. Boy, there's a lot of glitches with our slides today. Okay, so let's go on to sectoral balances here. Okay, what is this? Well, this is another way of thinking about this set of issues. It's a useful little tool for thinking about this stuff. So again, we go back, we got our original national income identity. We get so much use out of this thing. Okay, so there's another way of rearranging it. Again, we've got disposable income is income less taxes. And then we've got savings, which again is savings is the disposable income less consumption. So savings is the household income that ends up, we're going to say here for now in the household sector. We're going to ignore, again, in the ideal world, we would try to incorporate into our accounting the payments between the business sector and the household sector, but that's very difficult to do. So we're going to assume here that all business income ends up in the household sector. So savings just becomes household disposable income less consumption. So now we can combine all these things. We'll subtract or rather we'll subtract the left side of this thing from the right side of this thing. So we're subtracting, so y equals yd plus t. So we'll change y into yd plus t. And then we'll subtract all the stuff from the right-hand side. And then we'll just regroup these things. We'll combine, so this here is S, that's S. So we'll combine these two into S and then we'll group them with I. So that gives us this thing here. Then we'll group T with G. So that gives us this term. And then we'll leave X and M by themselves, except we'll flip the order and that gives us this term. Now what's going on here? Well, this is, we call it, we're going to call this the private balance. So it's the excess of private savings, household savings over private investment. This is the private balance. It's the income generated in the private sector minus the expenditure of the private sector. That's what that's going to be, because S is income in the private sector less consumption, and then we also subtract investment, and we're left with this thing S minus I, income, the excess income, the income generated in the private sector that is not used by the private sector. That's the private balance. This thing here we'll call the government balance or public balance. Again, this is income generated in the public sector. That would be, T there. Taxes, income generated by the public sector minus expenditure in the government sector, G. And again, T is, remember, net of transfers. So this thing here is income received by the public sector less spending by the public sector. And then finally over here, we've got the foreign or external balance. So, and that's, if you think of it this way, income generated from our country by the foreign sector. Our imports are income for the rest of the world. So this is the income generated from our country for foreigners. The income we generate for foreigners less the foreigners spending on our goods. So this is the excess income, the excess of income in the foreign sector, the excess of income in government, and the excess of income in the private sector. Or it's tricky, but people do like to think of it this way. This is the net savings of the private sector, the net savings of government, and the net savings of the foreign sector, where we think of a trade deficit is essentially the foreign the rest of the world in some sense lending us money. It is a trade deficit or a current account deficit is in some sense us borrowing money from the rest of the world. So you could call this net lending by the private sector, net lending by the public sector, net lending by the foreign sector. And the notion is, as a matter of accounting, all these things have to balance. So if one sector spends more relative to its income, one or both of the others has to be spending less. And it's a useful tool for thinking about things that can happen in the world, things that can happen in the economy. If you're going to have a story in which the household sector is saving more, that has to be, if the household sector is going to increase savings more, there's only a limited number of things that can happen. Maybe private sector investment is going to go up, or the government, if the household sector is saving more, the government has to move towards deficit. If this thing goes up, this thing can go down. Or if the household sector is saving more, maybe the trade balance will move towards surplus. Maybe those excess savings will in effect be lent to the rest of the world. But you have to have some consistent story. And it's actually a sort of a discipline because people do sometimes tell stories where these balances, if you think about it, are actually moving in an inconsistent way. People up at the Levy Institute used to really do a lot with these. They published a whole series of papers, 7 unsustainable processes, and there were lots of unsustainable processes that really focused on sort of how are these different balances, how can they evolve in a way that makes them consistent with each other. At one point, people really liked a story of what they called the dual deficits, where the government runs a deficit, which is here, and then to balance that, we have to keep this thing balanced, we have to have an increase in our trade deficit. So the signs here, you'll notice, are different. Here, a positive value is a trade deficit. Here, a positive value is a government surplus. So the notion, and that's again just the way the accounting works. So this dual deficit story was, if the government runs a budget deficit, then that's going to lead our country to run a trade deficit. Well, that is not a general story that applies everywhere at all times, or maybe necessarily even anywhere, but at a certain, back in the 1980s in the US and more recently in certain other countries, that story has really gotten a lot of purchase. So it's a tool for thinking about these things. Okay, so getting a lot of repeated slides here. I'll have to figure out why this is happening. All right, so I'm going to stop this lecture here and do a follow-up one on the sort of empirical evidence we have about the multiplier in the real world. The key things that I want you to take from this lecture are, first of all, the basic algebra of the multiplier, and the algebra itself is one thing, but you also want to be able, this is the more sort of complex version, and then, going back here, we have the the more, where is it, the more basic one. But the algebra of it, you need to be able to manipulate. But even more important than the algebra is understanding what this means and logically why it behaves the way it does. What is the story that we are telling about the world when we talk about the multiplier? So that's the big thing. And then just this sectoral balance thing, just as a way of, we can rearrange the national income identity to tell us something about sort of the range of possible developments that can happen in a real economy. And I mean, the dual deficits thing was a sort of reductive or one-sided version of the sectoral balances story. But it is true that all of these things do have to balance. And if you could split up the business sector from the household sector, that would be another point of balance. But at least, so if you're going to tell any story about, if a story that you hear, more often, if China is going to move towards a smaller trade deficit, if China is going to reduce towards smaller trade surplus, if China is going to reduce their surplus with the rest of the world, that thing's going up. If they're reducing their surplus, moving towards deficit, this thing's got to go up. So what's going to happen? Something has to happen either over here. Maybe they can do that by having more government budget deficits. Maybe this thing can go down by having more private sector investment. Or maybe this thing can go down if Chinese households are willing to save less. But some combination of those things must happen. If you want to have this thing go down, you've got to have a story about why this is going to go down or this is going to go up. or this is going to go up, or this is going to go down. Some combination of those has to happen if we want this to go down. So sectoral balances are a useful tool for thinking about sort of things that can happen and things that cannot happen in real economies. So we've got that, we've got our basic math of the multiplier and the sort of concepts behind it. And then in the next lecture, we'll talk about what evidence we have about the kind of multipliers we're likely to see in real economies.